Hi everyone, my name is Juan. Today I'm going to present to you paper The Short of It, Investor Sentiment and Anomalies. Okay, so just a quick introduction. The research question is, do investor sentiment and short sale constraints contribute to mispricing, and can they explain the profitability of a wide range of asset pricing anomalies? This is important because of three reasons. The first is to challenge rational pricing assumptions based only on risk. The second is to see if investor sentiment is indeed a systematic driver of anomalies. The third is to focus on the short side effect. All this relates to the existing works. The first is Miller's 1977 short sale constraint theory uh, with empirical anomalies in this case. Second, extending on Baker and Wurgler 2006 research into market-wide sentiment, and later on, this work would develop into a mispricing-based asset pricing model by the same authors in 2017. Okay, so what is the motivation behind this paper? First of all, the presence of sentiment-driven investors can cause prices to depart from fundamental values. This is, in essence, a question that has been uh, studied many time ago. So, presence of sentiment-driven investors and Miller 1977 short sale argument, by which impediments to short selling, for example, institutional constraints, transaction costs, they make investments being overvalued. If you mix these two concepts, for one part, you get that high sentiment inflates prices. And so if there is enough rational investors, they cannot correct overpricing because of precisely taking into account Miller's theory short selling constraints. As a consequence, mispricing persists more on the overpriced side of the stocks. When sentiment is high, the most overpriced stocks, or the short leg, fall back more. And so the greater profits are accounted when they're shorted. The objective then is to explore empirically if these two concepts could explain mispricing and if they indeed could be a partial explanation for a broad set of anomalies recorded until the time of the paper. So, what is the setup? They got three hypotheses. First is that taking into account the economic intuition I just mentioned, the anomalies, to the extent they reflect mispricing, should be stronger following high sentiment. Second, that the returns on the short-leg portfolio of each anomaly should be lower when sentiment is high, because if the returns lower, then the profits, because you're shorting them, are higher, right? And third, the long legs portfolios should have similar returns following high and low investor sentiment. This is because in this paper setup, the overpricing is the dominating mispricing, not underpricing. And so long leg portfolios should not have any relationship whatsoever to investor sentiment. They explore this in 11 anomalies that include financial distress, net stock issues, uncompensated equity issues, total accruals, net operating assets, momentum, gross profitability premium, asset growth, return on assets, and investment on assets. So, methodology, they follow first the Baker and Wurger 2006 measure for investor sentiment. This is a principal component, the first principal component of 6 measures of investor sentiment. Then they obtain a value-weighted portfolio returns within each decile of the anomaly sorting variable. So for each anomaly, they do this. And then they construct a long short strategy using the extreme deciles they just made, in this case, the first and the 10th. And well, the long leg is the high performing one. Data is from August 1965 until January 2008. And also they control for French pharma three factors. Empirical analysis has supports in the first, they use a dummy variable indicating the high and low sentiment periods, and they measure the excess return on the monthly treasury bill rate, right? So in essence, it's just a regression, and they change the dummy variable, which indicates if it is a high sentiment period or not. Second part is doing, instead of a dummy variable, taking the market sentiment index as a level and see if the relationship they expect maintains is positive, negative, depending on the hypothesis they want to prove. For this, they do a couple of robust checks. The first, try other market sentiment measure. To do this, they use the Michigan Sentiment Index, which has also been used in other investigations. Second, they control for other systematic risks and additional macro variables, such as liquidity risk. The results they find are robust to using this sentiment measure, and they remain after controlling for what could be considered systematic risks. As such, this is evidence, according to the authors, against a pure risk-based explanation. What are the key findings and the conclusion of the paper? First, each of the 11 anomalies is stronger following high levels of investor sentiment. This indicates a positive relation between investor sentiment and long-short anomaly profits, in essence, validating the first hypothesis. Second, that its stocks expected to decline had lower returns. We're talking, in this case, about the short leg, after periods of high investor sentiment. Again, as evidence for their second hypothesis on supporting the idea of overpricing in market-wide sentiment. Third, there is no relationship between benchmark adjusted long leg returns and investor sentiment. Yet again, this is evidence for the third hypothesis they had, and this is consistent with the idea of limited underpricing and overpricing being the dominating mispricing in the stock market, at least in the US. As such, what is the conclusion? That many of the anomalies reflect mispricing related to market-wide sentiment. And even if you look for risk-based explanations, it's a challenge for any of them to explain why is it only that high sentiment that the stocks in the short legs earn low returns. As such, we encounter open questions for the future. First, are authors omitting systematic risks that would reduce or eliminate seemingly anomalous profits? Second, do similar sentiment-related effects hold in other asset classes or even in other international markets? And last, has the relationship between sentiment, short selling, and anomalies changed after the publication of the paper? Bottom line, there is a lot more work to do to develop a better understanding of how sentiment plays a role in pricing of financial assets. But in the author's results, we see that the risk-based explanation might not be enough. We might have to consider something related to market sentiment and investor recognition. Thank you very much, and I'll see you on Monday.